Financial statement. The settlement of accounts is to calculate an income and the expenditure of the fixed period of time in company activity and compile the business showing such as profit or the loss of the period. Financial statements such as the balance sheet and the income statement are made in the settlement of accounts, and used as a document of the business analysis. Balance sheet. The list which compiled assets, liabilities and an amount of money of shareholders' equity is a balance sheet to clarify financial position of the company at a certain point in time. Income statement. The list which showed profit during a period and the details of the expense is an income statement to show the business result of the company during the fiscal term. Business analysis is done to scientifically find out the strong and weak points of an enterprise. It is based on the financial statements such as balance sheet and the income statement. In business analysis, the analysis is done with regard to three perspectives. These are the ability to get profits, profitability, their capability to pay, liquidity security, and the ability to grow, growth. A good company will have large profits and an excellent capability to pay and will be growing. Here, we will study the typical method to figure out the key performance indicator of business analysis. One, profitability analysis. 1. Gross profit to net sales ratio. When there is a change in the gross profit to net sales ratio, it is necessary to confirm whether the cause is in the cost of sales or in the sales price. Two, operating profit to net sales ratio. When the operating profit to net sales ratio is low, efforts have to be made to reduce marketing expenses, etc. 3. Ordinary profit to net sales ratio. When the ordinary profit to net sales ratio is low, efforts have to be made to reduce amounts of debts, etc. 4. Turnover of total capital used. Increasing the turnover of total capital used leads to the effective use of capital and increases profits. 5. Return on equity, ROE. This is the proportion of profits in relation to the amount of shareholders' equity used in operations. The higher this rate is, the lower the amount of shareholders' equity is used in making profits. A higher rate means a good performance. In business analysis, the return on equity, ROE, is the main index for profitability. Two, liquidity, safety, analysis. 1. Current ratio. Liquid assets are used to pay liquid liabilities, so the higher the ratio the better. A current ratio of 200% is desirable. 2. Equity ratio, equity to total assets. The equity capital is the same as shareholders' equity. A higher equity ratio is good for the company. 3. Growth analysis. 1. Sales growth rate. The sales growth rate is judged in comparison with other companies.